we're here to talk about Silicon Valley real estate market in the Greater Bay Area this week, number 17th, April 27th. These URLs will be explained at the end. And here's our first data slide. What we're looking at is the active listings this week compared to the previous 10 years, the same week. You can see that we're very small shade of pink. It's clearly getting back to sort of where you'd expect it to be. Yes, almost all the areas are under 100%, but the biggest really drop down is about 15% that's common in Alameda County. A lot of these areas are less than 15. I think this one in Campbell is probably the greatest at 28% below where you'd expect it to be. Yes, there's still a shortage of inventory, but it's getting more normal. Now looking at the number of offers, there's still a shortage of the number of offers, but again, most of these numbers are probably 90% or better, although there's a lot of mid-70s, so maybe 90 is a little too high. Santa Clara County is basically 90, San Mateo County is probably about 80, and Alameda County is probably about 75%. So again, there's also a lack of offers compared to normal. Now, here is the days unsold inventory. This is the supply-demand ratio. This is the ratio between the active inventory and the sales, the number of offers each week. And now you can see most of the areas are white in color. Alameda County is at 99%. Santa Clara County is on both sides of 100%. San Mateo County is slightly over 100%. When you look at the ratio, which is the speed of the market, the pressure of the marketplace, it's about normal. Now, remember, Silicon Valley, since about 1998, with a few minor exceptions, has been a strong seller's marketplace. So even though that this is coming into basically the realm of where you'd expect it to be, it's still a very strong seller's marketplace. Now we're getting rid of the 10-year normal, and we're just looking at what the days unsold inventory is today. So this is how long it would take to sell the existing inventory. And I consider it to be anything under 6 weeks or 42 days to be a seller's marketplace. And you can see pretty much everything on here is pink in color, and therefore under that 42 days. The major exceptions are the expensive areas in San Mateo County coast, and then Oakland, and barely on the other side. So this is a balanced marketplace, is San Lorenzo, and Hayward, which is one micro market area. But the only area that's really favoring the buyer significantly is the expensive areas in San Mateo County. Now we're looking at a similar data point, but one that might be easier to understand. This is simply the long typical seller. How long are they taking to sell the properties? And basically, this means 3 out of 4 sellers are selling their property in less time than indicated here. And in Santa Clara County, basically, that's 10 days. You go up into San Mateo County, and it's probably closer to 12 days. And in Alameda County, it's probably right around 10 days. Again, most of the areas are right around 2 weeks to sell 3/4 of the inventory. Only 1 out of 4 sellers is taking longer than 2 weeks to sell their property. So a pretty fast-paced marketplace. Now we're looking at the seller's ask price adjustments. And the reason I started looking at this data point was if you wait for sold price to come out, you're waiting for the length of escrows, which are typically 4 to 6 weeks. Looking at what ask price is done gives you some indication of where the seller's expectations were in relationship to the marketplace. So as the number of price reductions increase, the magnitude of them increase, that means the sellers were overestimating the market. So the market's either softening or has been aggressive, and the sellers were trying to be more aggressive. You don't obviously know which, but if you follow the trend, you can see when the market's slowing. Again, you can see there's some areas that are red in color. Those are where they're actually raising their price, and that happens under several circumstances. So everything from 1/4% to 1% is white in color. Everything more than 1% price reduction is blue in color. And that's a tight metric. And the reason it's a tight metric is somewhere around 85% of the sellers are not reducing their price at all. They don't have time. They've priced their home correctly, those kinds of things. Now, this is the frequency of price reductions. You can see in Cupertino, 1% of the sellers are reducing their price, up to 14% in South County. The biggest area I'm seeing right now off the bat is 16% in Oakland. And, 16% is only what, 1 in 7 sellers are reducing their price. So price reductions are not very common. Lack of price reductions favors the seller, and that's why it's red in color. Now we're flipping over and we're waiting for escrows to close. So we're looking at the demand. This is the pressure the buyers sense. And you can see that the San Mateo County coast is a reduction of 1.5% basically. And then you start going up 1.5% in the expensive areas. And the highest area I'm picking up right off the bat is in Campbell, Cambrian, Santa Clara, and Willow Glen, where there's basically almost a 15% increase. Oh, I just spotted Berkeley and Alameda 17% above the asking price, and that's average. That includes the few percentage of those sellers that are taking less than their asking price. But on both sides, the average overbid is 17% above the asking price. This is the frequency of overbidding. So how common is overbidding? The lowest number here is in the San Mateo County coast, with basically just over 1/3 of the sellers getting more than their asking price. And the highest number I'm picking up right now is about 85.5% in Cupertino and Sunnyvale. Milpitas, North Valley, Berryessa, and Santa Teresa is not far behind. And Campbell isn't far behind either, because that was the highest magnitude in Santa Clara County, and it's about third place in frequency. So magnitude and frequency aren't always together. Sometimes areas or buyers are overbidding significantly amount. Sometimes it might just be the practice of the listing agent in that area where they're reducing the price artificially to entice multiple offers. Here now is looking at the appreciation long-term, go all the way back to the last 9 months of 2015, the last 3 quarters. I would have liked a whole year, but our prices tend to skyrocket in the first quarter, and it did in 15. And when you have rapidly increasing prices, it depends on when the transactions happened, how up to speed they were. So to try to get a more accurate uniform base for measuring my appreciation, I took just the last 9 months. You can see that Milpitas, North Valley has gone up 108%, so you've more than doubled your money. And then same with Union City and Newark. Red in color is large appreciation, which favors the current owner, who is the seller that has owned it for part or all or more of the period of time in measure. And then the blue colors are the low appreciation areas. And if you look at it on the map, you can see basically the peninsula is where the market's the slowest, the least appreciation. The most appreciation is sort of in your affordable outlying areas. And basically what I think this is directly related to is the pandemic. People historically wanted to be close to the job centers. Now with more remote and more flexible commute options, people are willing to travel further, longer time and distances, because they don't have to do it as often, or they can do it outside of peak rush hours. So now your outlying areas have been more desirable, and whatever is the most desirable in the recent time frame has the highest appreciation overall, typically because of compounding. Now we're looking at the sold price, and instead of just looking at the median sold price, which is the middle number for any particular micro market area, I also look at the least expensive and the most expensive in that area. And that gives you a sandwich. It gives you a better flavor of what's going on with the price range. And you can see in South County, roughly 500,000, $500,000 is the first 40% from 10% to 50%. And then the second 40% from 50 to 90% takes a whole million. And that kind of spread is very common. The first 40 going from 10% to 50% tends to be way more condensed than going from 50 to 90%. It's hard to get, because the land value, anything that you can build a property on is worth a certain amount of money. So that causes the low end prices to get bunched up. The condition and size of the property become more irrelevant as the land value becomes a larger percentage. But this way you can quickly come down and see what micro market area you can afford or want to afford. And here's a summary. We started off with the active and the offers and the DUI compared to the 10-year normal. Then we looked, and basically starting with the 10-year normal all the way up to ask price, these are the current market adjustments. This is what you look at to get a sense of what the market is right now. Then the overbidding is a delayed by 4 to 6 weeks, call it 5-week delay. So this is not necessarily in sync with what the current market conditions are. And, it's hard to tell, but, in a couple more weeks, we may be able to see that the overbidding is pinker in color than the current indicators. The other metric or the other influence you have here is all these scales that I've come up with are arbitrary, and I could be off by a little bit on any one metric on what I should be using. So even though if you had a long-term steady state marketplace, which we never have, the colors might not even adjust equally because I might not have the right metric, or maybe the metrics aren't 100% matched. So it's just an indication. You look over here and you come down here to Fremont, it's a pretty red all the way across. You come up here to something like the San Mateo County coast, and it's fairly blue all the way across. You just get a sense of what's going on. And then again, the appreciation, the price ranges, and for the first time, you're seeing the monthly payment over here, and that assumes an 80% loan using the national average for 30-year fixed jumbo money. Now we're getting rid of the micro market areas, which are really important to understand what's going on in a given segment of the area where you're looking at purchasing a property. But now we're putting everything in a blender and just what's the market doing overall. So we come down here and we see inventory. So inventory, looks like it's back down a little bit this week, which is a little bit surprising, but you're somewhere around 76% of where you'd expect it to be. So you're losing about 25% of the market. Then you go up to the number of offers. Offers are just doing slightly better, maybe 78, 79%. And because the offers are doing slightly better, but they're real close together, the DUI, which is a separate metric and isn't linked, instead of being just below 100%, which is what you'd expect based on offers being more offers than active listings, you'd expect it to be low, but instead it's right just over 100%, maybe 101%. So the market's slightly faster than it typically is for this time of the year. And that should also be based on the last 10 years. Now, this is just showing the volume of transactions, and it's something that I am still concerned about, but nobody else seems to be. But look at the lack of offers we've had. We've only had 2,235. The only year we had lower offers was back in 2020, which is when we had shelter in place. And you can see it was dropping down fairly rapidly. And that's because we weren't supposed to be showing properties at that period of time. And it's pretty hard to write up offers if you can't even show a property. My concern is when you have the 24th out of the 25th slowest number of transactions, and the only year that beat you was the pandemic year, there isn't a lot of buying activity, but there's also not a lot of sellers for the buyers to buy. Now we're looking at the payments, and here we're looking at the cheapest home, 10 percentile. You're coming in with a monthly mortgage payment of about $7,000. The typical home payment's about maybe $13,250, and the most expensive homes up here somewhere around just shy of $27,000 a month. And again, that assumes the 80% loan, and the people that are buying the most expensive homes do not tend to borrow 80%. Now what we're looking at is a 5-week distribution of ask price reductions. So we're looking back 5 weeks in period of time of when the sellers got their offer, what did they have to do to adjust it? But we look at that every week. But we're starting to start off a year ago, which is the blue dashed dotted line down here. The current week is the green dashed dotted line up here. So clearly the market is better this year than we were last year down here, and it's significantly better. But then what we're going to do is we're going to start off with the blue line, jump forward a month at a time, and a month at a time is 4 or 5 weeks. I don't do anything on a monthly schedule, so I just try to keep the day of the month about the same for the first 9 months. And then when I hit 3 months, I jump from 13 weeks, 3 months to 12 weeks and go weekly. So here we go. You can see it's going down. Now it's starting to plateau. There's sort of the bottom of the marketplace, going back up now. And starting right about there is where the market sort of hit the plateau on the top end. So we're sort of at the top of the marketplace for this year. And again, this is where we started off last year. So we went down, we turned around, and we came back up. And in my opinion, it appears that we're at the plateau for the year, which means that the prices, the offers that are being accepted right now are probably going to be the high priced offers for the year. No way to know that until it happens, but that's what would typically happen. Now we're flipping over and looking at the same information, but based on overbid. So now there's a 5-week delay. And so what I would expect here is for the plateau maybe not to quite have been reached, but what you can also see is, again, the current line, the green line, is significantly better than the data a year ago, the blue dashed line. And we're going to start off a year ago and then go monthly and then weekly. So there we're going. You went up a little bit and then you went down, which would tend to indicate we're still got a little bit more to go up this year. There's the climb up. And you're still climbing, although the climb is becoming less significant. But I would expect that climb to continue for a couple more weeks based on the data we've looked at so far. Now what we're doing is looking at the data compared to the normal cycle. So the three thin colored lines, the red, the gray, and the blue, are your annual cycle. And you can see how significant that is. And when you get to 2023, January 1st, I expanded out the x-axis because if we were looking at this kind of tight time frame here, it would be difficult to see what the market trends are any given week. You would not pick up little dips like this. You wouldn't pick off this little plateau that we had here or the dip we had right here at the end of March. So I expanded out the x-axis to make it easier to read the graphs for the last full year. So you can see that would be 2023. So you can see the weekly cycle. And then I also blew it out for the current year that we're in. And so the way you read this graph is you're looking for how the purple line is moving relative to the gray line and then the blue or the red line. So here you're raising more steeply, it appears to me, on the purple line than the gray line. And the way you tell that is down here at the end of March, you were basically very close to the red line, even if you come back to the high point. And now vertically, you're a little bit more separated. This last week, we were completely horizontal, which is not common and makes me question my data. And by the way, I did make it through some of my quality checkpoints, but did not make it through all because I suffered through multiple utility outages yesterday. And so I did not have as much time to do this. So I would have, in a normal week, I would have checked to make sure this isn't just duplicating last week's data. I'm not aware of that happening, but I also just want to say I've been checked it. So now moving on to the current active inventory, and because inventory is normally increasing at this time of the year, and we were flat, we decreased slightly relative to what the market normally is. Because what this graph is basically doing is taking that gray line and pulling it straight at 100%, and then measuring whether you're above or below it and how far. Now we're moving on to the number of offers, and the number of offers is still climbing. But if I was to look at the number of offers climbing on the gray line, I would almost say the gray line is slightly steeper. It's hard to tell. I also will point out that this dip down here happened most likely because the shelter in place data. I'm now using a 10-year moving data. So when you come back to before the pandemic, it really wasn't impacting the data. Once we got to the pandemic, it starts impacting it by 1/10 of the value. And that's why the dip down's there. Here we're looking at the Silicon Valley offers versus normal. And you can see that compared to normal, we're right at 80% of normal and we were flat. So we went up, that's telling me we went up at the same rate. So even though to me, it looks like it was going up slightly slower, the data is indicating that it's going up at the same rate. Here's the days of unsold inventory. We've gone from somewhere between the gray line and the red line to now we're right on top of the gray line for the last couple of weeks. That means we're basically having this normal speed of the marketplace. Now, the thing that's going to be interesting is, do we acknowledge this little dip down? That little dip down could be Easter. Easter was early this year. Easter is one of those holidays that moves around by quite a few days. I think it's like 5 or weeks or something that it can move. So it impacts the data, because every holiday impacts real estate in the negative direction, except for Mother's Day and Valentine's Day. So here's the days of unsold inventory versus typical. You can see we went way down. Now you're coming back up and you're approaching 100%. This is 90%. So you're somewhere around 98% still. So that's like 2% faster. So, but again, I keep trying to stress that Silicon Valley is typically in a seller's marketplace. So even if we're slightly slower than normal, it would still feel like a fast-paced market. Now we're looking at the time on the marketplace, and time on the marketplace is one of the fastest we've ever had. We're almost touching, if not touching, the red line here. And these step functions are normal because when you're looking at a database, you either take 11 days, 12 days, or 13 days to sell the property. And there's a lot of homes selling at each one of those. So the market has to heat up quite a bit to take 1 day off of those. And as you can tell, looking back in the time frame, the lowest this number's ever been is 11, and we're at 13. So we still have 2 days to lose to get back to the lowest. But still 13, if your lowest is 11, is pretty impressive. Here's the days to market the property versus typical. So 80%. So you're selling them 20% faster than you typically do. So right now we were selling in about 2 weeks, or maybe it was 10, I think it was about 12 days. If you sell in 12 days and you normally take 20% longer, you're somewhere up around 15 days normally. Here's your ask price reductions. So again, even though we're still in a fast-paced marketplace, the typical price reductions is the gray line, and the sellers are coming down here on the purple line currently, which is a little bit closer to the blue line. So sellers are taking slightly larger price reductions than they historically have based on the 10-year average. Again, there's a normal pattern. Real estate is very cyclical, and that's why I do everything on a weekly basis instead of a monthly basis, because I believe the weekly influence is way more significant than the monthly. Here's your average ask price reduction versus typical, and you can see that they're taking a little bit more price reductions. Here is now, because the metric we've been looking at on price reductions is so tight, I'm now blowing away and ignoring 90% of the marketplace and just looking at the 10% of the market that's taking the biggest price reduction. And what is it doing? You can see we were almost normal. We came down, we were taking bigger price reductions, and we're starting to climb up at a time when the price reductions are normally coming down. What does that mean? It's hard to tell, but we're still slightly above the normal number of price reductions for just that outlying 10%. This is going to fluctuate a little bit more, because you can see you went from 100% down to 80%. So you have a 20% swing. If we went back and looked at the total price reductions here, your swing is basically from about 97% to just over 100%. So your swing's only about 4%. And that's why it's so hard to use it. You know, it's much easier to do a 20% swing and see changes than a 4%. It's like putting it on a magnifying glass of a factor of 5. Here's your frequency of ask price reductions. So the first 4 slides, we were looking at the magnitude. Now we're looking at frequency. How common is it? And the gray line is where you'd expect it to be. And appears to be a fairly abrupt turn, maybe last week, away from slightly above normal to now slightly below normal. With fewer sellers taking bigger than normal price reductions. And here you can see it's showing up right about 100%. Here is now your overbid. So this data is going to lag behind. And again, if you look at it, we're sort of getting very close to where this plateau is. And this is a 10-year plateau, which means it's very typical for the market to slow down. So we're up here. And if you look carefully, and I'll try to stay away from the actual data, you can sort of see that we were rising very rapidly, and now you're rolling over. And what I would say is we're rising very rapidly, and you're about ready to roll over. And this is happening at the same time of the year. That's why you compare it to the same time of the year. So now the magnitude of overbidding that happened 5 weeks ago when these offers were negotiated was pretty constant with, you expect it to be level. So this week, next week, the week after, you expect the numbers to be fairly level. And this is going to be, each line here is a quarter, which is 13 weeks. So if I look at this might be 10 weeks. Basically, for the next 10 weeks, you'd expect overbidding to be fairly level. That means in about 5 weeks from now is when the market will start coming down this downslide here, because remember, there's a 5-week lag time. Here's the overbidding compared to normal. And so you can see you're slightly above, you're about 3% more overbidding than normal. Again, it's taking that gray line on the previous chart and pulling that out straight. The other lines are not necessarily the same lines. Here's the frequency of overbidding. So just like with the price reduction, so you look at the magnitude of it, and then you come back and look at the frequency. So the frequency is more common, significantly more common. In fact, you're halfway between where you'd expect it to be and the most that you'd expect it to be. We're talking about overbidding, so it would be the most you're expecting. So you're halfway between what you're would expect, the gray line, and to the most you'd expect of overbidding, the red line. Here it is typical, and you can see that you're above the gray line or going towards the red line. And then here's your long-term price appreciation. And again, you can see the dip down that happens at the end of every year. And again, right after the first quarter, you sort of have this apex, and maybe it changes because here it was getting close to the beginning of the second quarter. But if you start looking at this data, and again, I'll stay away from the data so I don't cover it, it looks to me like that this last week's data sort of rounded off that rapid increase in pricing. Here now we're looking at the 3 counties that make up Silicon Valley. So Santa Clara County is in the blue, and it's got the second most inventory. Alameda County's got the most inventory, and San Mateo County's got the least. That doesn't surprise me. If you come back and look at the left-hand side, that's the normal order over here. That's basically the size of the counties. Now the number of offers accepted. This is surprising. Look at how many more offers are being accepted in Santa Clara County versus Alameda. And when you look back historically, they're either the same or Alameda's on top of Santa Clara. So for Santa Clara County to be outperforming Alameda by about 20% in rough numbers, that's pretty significant. So Santa Clara County is doing better than Alameda as far as the number of offers accepted. Here's the speed of the marketplace. Santa Clara County is the fastest, then Alameda County, and San Mateo County is the slowest. But even when I say it's the slowest, it's still 38 days. So that's below the 42 days of a seller's marketplace. Marketing time. Santa Clara County has the fastest marketing time, and it's down at 11 days. Now, if you come back here, clearly Santa Clara County had 9 days. So Santa Clara County has been sort of the heat center of the marketplace for a while, where before the pandemic, it was more San Mateo County. Here's the magnitude of the price reductions. Santa Clara County has the least price reductions. San Mateo County has the second, and Alameda County has having the most price reductions. And again, this is the tight metric where I'm looking at everybody because you're about 93.35%. So that's only about it's about 2/3 of 1% of a price reduction. This is the frequency. It's least common in San Mateo County, which is sort of, again, surprising because San Mateo County is doing the least well in a lot of regards. The highest in Alameda County, and second place is Santa Clara County. This is the frequency of overbidding. So even though Alameda County was not doing well as far as the numbers, the magnitude of the overbidding is the highest, coming in at about 111%, where Santa Clara County is just over 110%. San Mateo County is down at 107%. Here's the frequency of overbidding. So how common is overbidding? Again, Alameda County is coming out on top. That may help explain why it's got the most magnitude, but it's got the most magnitude and the most frequency. Santa Clara County is in second, and then San Mateo County is third. But it's San Mateo County being third, still 70%, 7 out of 10 sellers are getting more than their asking price, or 3 out of 5, depending on how you want to say it. Here's the appreciation. Look how well Santa Clara County now is outperforming. Alameda County did the run up earlier, and so Alameda County became more expensive relative to Santa Clara. Then people came back into Santa Clara County for affordability and shot up the appreciation in Santa Clara County. I did not adjust the horizontal lines on this slide, but you can see Alameda County's down a little bit from last week. You can see Santa Clara County appears to be up and San Mateo County appears to be up. So they're still close together, but the spread has increased slightly. Same information on regular paper for those that prefer. Here's those estimated payments in the same order. Now here's the actual numbers. The number of new listings this week compared to last week, it's up across the board around 3.25%. The active listings, I did not update the active listings. That should have happened automatically. Okay. Offers accepted is up by differing amounts from 0.5% in Alameda County to 0.4 in Santa Clara. The big increase was in San Mateo County at 4% for a 1.2% overall increase. I'll let you look at whatever number's most important, but you got it for you. You got Santa Clara, San Mateo, and Alameda County individually, and then you got Silicon Valley as a whole. Again, this is week 17. We're leaving Silicon Valley, going into Northern California region. 5 regions. Silicon Valley is 1 region. Cities is number 2. North Bay is number 3. Central Valley is 4. And Central Coast is the 5th region. Here's the numbers. Again, you can pick out whatever metric is more important for yourself. Here is the data. So now what you're doing is looking at inventory compared for the 5 regions. The gray is North Bay, which has the most. Normally, if you come back and look at the history, North Bay and Central Valley are very close together. Central Valley seems to have eaten up its inventory compared to the North Bay. Silicon Valley is normally in 3rd place. I would tend to say that Silicon Valley right now is doing a little bit more inventory than Central Valley or North Bay compared to normal. And it's harder to comment on San Mateo and the Central Coast because their scale is so much smaller. Then most offers are in Silicon Valley. Central Valley and the North Bay have roughly the same inventory, same offers accepted. And San Mateo County is in 4th place and Central Coast has the least. And I think there is a difference because if you look back over time, Central Coast and San Mateo County, or the Central Coast and the cities are roughly the same. And here the cities is clearly higher. You don't know which, in Central, the cities is almost normal and the Central Coast is cooler and everybody else is doing less than normal. So the fact that cities is doing its normal volumes, it says it's probably doing one of the best relative to where it normally would be. Here's the speed of the marketplace. So now Silicon Valley is the lowest. Central Valley is next. North Bay and the cities are right next to each other and close to the Central Valley. And the slowest is the Central Coast. And there is a difference between 60 days to sell your inventory and 40, or in the case of Silicon Valley, 30 days. Here's the marketing time. You can see the patterns roughly the same. Silicon Valley has the fastest marketing time, and it looks like at 13 days. The cities and Central Valley are next at right around 23 days. Then you have North Bay and Central Coast coming in at 40 days. So it takes a month and a half for 3/4 of the sellers to sell in Central Coast. Compare that to less than 2 weeks in Silicon Valley, and that gives you an idea of the difference. Here's your price reductions. The least amount of price reductions is in Silicon Valley. The most is in the cities. Again, it's fairly close together, or basically a 1% separation across the board. Frequency, least amount in Silicon Valley, then the cities, then the Central Coast. So even though Central Coast is taking longer to sell, they hold on to their prices. And the most price reductions is North Bay. And finally, the absolute most is the Central Valley. Here's the magnitude of overbidding. Silicon Valley and the cities are pretty close together compared to your others, then followed by North Bay, Central Valley, and the Central Coast. Frequency of overbidding, Silicon Valley has the most overbidding at 78%. Then you drop down to the cities, it looks like it's about 67%. You drop down to North Bay, which looks like it's about 55. Central Valley is 54. And then you drop down to Central Coast at 42% of the sellers getting more than their asking price. So again, there is definitely a difference between 42 and 78%. And we lost the last data point for Silicon Valley, but I would suspect it's up here. You can see that it looks like the North Bay is here. Central Coast shot way up here above the yellow line, which is surprising. And then the cities is showing up right here. And again, I apologize. I had over 12 hours of cumulative blackout yesterday, so I was way behind the 8 ball on the data. Here's the median prices just for the different regions. So you can see the cities is the most expensive: Silicon Valley close, Central Coast, North Bay, and the Central Valley is the most affordable. Here's the payments going to be in the same order because it goes through the same mathematical formula. And what we've been talking about here is week number 17 in Silicon Valley and then the Greater Bay Area. The blue YouTube URL gets you to the archive. If you want to type less, you type in the green URL, which I call my root URL. If you add in 2024, you can join the presentation live Saturday morning at 9 a.m. You add in H, the year 2024, month 04, day 27, and you get the handout, and it is up. And any particular episode, you just put in the month, year, date. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information is on every slide as well as here. I've been working in the Silicon Valley since 1981, willing to work with buyers or sellers. Reach out to me. If you have any comments about my statistics and how to improve them, go ahead and reach out too. I'd appreciate some more feedback. Thanks. Let me see if I have any questions. Not seeing any unmuted mics. Have a great week, everybody. Take care. Bye for now.